a summary of the accounting entries under the premium method. When premium is paid, joint life policy premium account debit to bank. Mind you, premium is being treated as an expense. So at the year end, profit and loss account debit to JLP premium. So this is an expense. It is treated as an expense. So there is nothing. We don't have any asset. Premium paid, transfer to profit and loss account. On retirement, what happens? Insurance company account debit to joint life policy with the surrender value. If it is due, when it's received, of course, bank account debit to insurance company. Now what happens? We have a JLP account with a credit balance. JLP account debit to A, to B, to C in the old profit sharing ratio. This is the scheme of entries under the premium method. But what happens if JLP is shown as an asset? It will be shown at the surrender value. So, when premium is paid, JLP account debit to bank. JLP, what is JLP? It's an asset. End of the year, this asset, but we can show it only at its surrender value. We cannot show it at a higher value, right? So, what do we do now at the year end? We write off the excess amount. Anything above the surrender value in the joint life policy account, we write off to the profit and loss account. Profit and loss account debit to joint life policy with joint life policy account balance in that account minus surrender value. So JLP will be shown at the surrender value. On retirement, insurance company account debit to JLP. So as a result, what happens? The JLP account gets closed because it was shown at surrender value and here we receive the surrender value. This account gets closed. Money is received, bank account debit to insurance company. So nothing is actually going to the profit and loss account here. Mind you, if we compare these two, the difference is that every year 4,000 was going to the 4,000 in our previous example, premium was going to the profit and loss account. So at the end, on receipt of surrender value, that amount which is received is credited to the old partners in the old profit sharing ratio. Under this method, what happens is, what goes to the profit and loss account? Only the amount in excess of the surrender value goes to the profit and loss account. As a result, every year the profits are not as low as it would have been in the premium method. So the partners actually get a greater share of profit every year since premium is not being taken to the profit and loss account fully. But as a result, at the end, on maturity of the policy, there is nothing to be credited to the profit and loss account. Nothing to be credited to the partner's capital account. Next, if there is a joint life policy asset and a reserve account, on payment of the premium joint life policy to bank, at the end of the year, we pass an entry called profit and loss account to joint life policy reserve with what amount? With the amount of premium. And also, anything in excess of the surrender value, joint life policy reserve to joint life policy account, so that now the balance in the joint life policy account is the surrender value. Balance in the joint life policy reserve account is also equal to the surrender value. On retirement, on surrendering, what happens? Joint life policy account debit to joint life policy with whatever balance is there in the joint life policy reserve is just transferred to the joint life policy account. For the surrender value due, insurance company account debit to joint life policy and close the joint life policy account by transfer to the old partners in the old profit sharing ratio. When money is received, bank account debit to insurance company. Now, having discussed these three methods, there could be a small variation here. Under the second method, we show the joint life policy account at its surrender value. Now, suppose retirement occurs on a slightly different date, a little after the surrender value. it is possible sometime that the amount which is received from the insurance company is slightly more than the amount shown as surrender value in the balance sheet. If that be the case, and if there is a balance in the joint life policy account, after we pass these accounting entries, if there is a balance in the joint life policy account, it is best we close the account by transfer to the old partners in the old profit sharing ratio. If the amount received is exactly equal to the surrender value, there will be no balance in the GLP account, in the joint life policy account. However, if the amount received is slightly more than the surrender value, then the balance in the joint life policy account will be transferred to the old partners in the old profit sharing ratio.